This is the daily fiscal pulse for the 12th of June, 2026. We're looking back one trading day. The numbers you're about to hear reflect how the flow settled through Friday's close. Before we dig into the data itself, let's acknowledge what's moving the needle in the headlines. The Iran and Middle East conflict is front and center. You're also seeing significant coverage around Trump's confidence in Fed Chair Kevin Warsh, which extends well beyond just interest rate expectations. That narrative is clearly bleeding into price action across the board. Against that backdrop, here's what the fiscal picture is actually showing. The net transfer landed at $28.7 billion. Standing alone, that number looks reasonably stable. The real story though is what's happened to the shorter-term trend. The 5-day flow has been cut roughly in half compared to recent weeks, and the primary culprit is tax receipts, which came through at $42.9 billion. The ES futures confirm this narrative. Closing at 7,434, they are sitting well below the 20-day moving average of 7,488. The 20-day range is spanning 385 points and it's pushing downward. So when you look at both the flows and the price action together, they are telling you the same story. Zooming out a bit makes this slowdown impossible to ignore. Daily government spending, measured over the last 5 days, is averaging around $2.6 billion per day. Now stack that against the 20-day average at $12.6 billion per day. That's a meaningful deceleration. Less cash flowing into the economy means less purchasing power reaching households and ultimately less capital circulating through the markets. That's how financial conditions start to tighten. Looking at year-over-year comparisons, the picture doesn't shift much. Spending sits roughly flat at $1,110.2 billion. There's no material swing in fiscal support to work with. From a trading perspective, the fiscal backdrop isn't handing you a clear directional edge at the moment. The conditions gauge is running at -42. That said, history matters here. We've encountered this type of environment multiple times before, and even with tighter liquidity, the S&P has averaged gains of about 1.6% over the following month. Price action doesn't always move in lockstep with liquidity flows. Markets can, and frequently do, still work higher. The margin debt picture adds some texture to that story. Currently sitting at the 100th percentile, that's historically been more of a caution flag than a go-ahead signal. This is where the pieces fit together. Fiscal flows are trailing last year's pace, which means the shock absorber in the system is thinner than it was. When sentiment turns positive, equities can still climb. But when a risk event materializes, like a potential escalation in the Middle East, downside can accelerate quickly simply because there's less underlying liquidity to cushion the move. 3 days running now with declining fiscal transfers. That kind of deterioration usually shows up in equity markets within a short window. Keep an eye on 2 items ahead. The 15th of June is the quarterly estimated tax deadline for Q1, and that's the type of scheduled event that can shift near-term flows considerably. The data absolutely reflects fiscal tightening, but the rate at which conditions are deteriorating might be starting to moderate. How those scheduled transfers actually land will likely dictate what happens next. That's the situation as it stands.